Hey, good morning, everyone. Surprise live stream on the day before New Year's Eve, and it's Monday. The team is actually off, and I am actually going to be shortly on my way, not shortly, tomorrow morning on my way to India and then to Asia for like about 3 weeks. So today is the best day to do it. Last live stream of 2024. Well, what a year. Yeah, what a year it's been. Started out pretty difficult for us. Ended, yeah, in like a blaze of glory. And yeah, I mean, prices have come off, but that's typical at year end after you have big moves. People take profits. People tend to sell things, take profits. Remember, I mean, the vast majority of activity in financial markets is short term. And hedge funds, mutual funds, any professional manager is measured based on their performance based on one calendar year. That determines if you'll get whatever fees are associated, performance fees for a hedge fund, dictates obviously bonuses, dictates promotions. So there is a huge behavior effect that drives selling of winners, selling of losers, buying of some winners to present a better appearance than what you might be otherwise showing just by performance. That's called window dressing. So there's like a whole series of behaviors that happens as a result of the calendar effect of performance, which is that December 31st is like, yeah, people like, oh, you had a great year, or you had a terrible year, or you had an in-between year. I'm taking the money away from you. I'm giving you more money. So not a surprise necessarily to see Bitcoin come off its highs, Tesla come off its highs, lots of stocks that people be like, why is it going down, Paul? You told us this. I mean, listen, there are no straight lines in investing. Everything can rise, can fall. Obviously, I can be wrong. There's no perfect records. I had someone write me on X and say, it was like, he's like giving me a hard ratio. And I was like, he was like, does anybody still listen to you? And I said, yeah, people who bought Bitcoin at 10,000, Tesla at 22, or MicroStrategy at 16, Palantir in the 20s, Fannie Mae. I mean, obviously at this point, there's an entire series of winners. But if you just picked one or two stocks and you don't have a winner, you're like, oh, you're a loser, you're an idiot, you're dumb, you're stupid. I mean, it comes with the territory, one of the fundamental nature of like doing this, where you're picking and there's uncertainty, there's risk, there's losers, there's winners, is that you want a scapegoat. Yeah, that's me. Like you're an idiot. So I mean, it comes with the territory. But for today's live stream, we're going to keep it kind of short, being that it's short notice, it's a surprise, but hey, it gets recorded and it's there and it's available for people who want to watch it. And I'm going to be traveling tomorrow anyway. And the next one, we'll probably have to be on the 6th or 7th. I'll probably have to do it from my mom's place, or maybe when I get to Asia. I'll have to see. Well, either way, we'll do something to accord for it. But let's go over what happened in 2024, what is setting up for 2025 in my judgment. And then I can see questions coming up on certain stocks, etc. So throw your questions in. Last chance in 2024 to have your questions answered. But before I do all that, let me do The legal disclaimers and disclosures, which is this live stream and all the content from ATG Digital, is not investment or financial advice. It is presented to you as opinion, information, engagement, and probably most importantly, entertainment. Whatever you choose to do with it, it is your responsibility because it is your money. So, take some of it, use some of it for additional research, ignore all of it, whatever you want to do. Hey, it's on you. All ATG Digital may contain errors, oversights, and mistakes. In other words, you're not guaranteed. Just because I come here and talk about something, you're not guaranteed to make money. It is not a 100% certainty that, it's going to all work out. And if you don't like that, hey, ignore this, shut this live stream off, move on. It's all okay. Understand that investment operations, which is what? Buying or selling a stock, crypto, options, everything. They have significant risk and can lead to the loss of your principal. Bottom line, you can lose money. I don't have to talk about the other side of making money because that's a good outcome and nobody needs a warning or a disclosure for that, right? I, the owners, employees, contractors of ATG Digital, we own, trade, transact in the securities I mentioned in this video and all the content from ATG Digital. We do not take money from companies or from crypto promoters, sponsors, etc., to recommend their stocks or crypto tokens. So for better and for worse, for good and for bad, for gain and for loss, whatever you're getting is our unique, independent opinion. Finally, we put out a lot of media. I mean, we're called ATG Digital, and we're a media company. We're not an investment advisor. We're not a financial advisor. We provide you our ideas. We create content about investing. That's what we do. And a lot of it is for free, like, for example, this YouTube live stream. I also have a podcast, and there are people who like that a lot. It's called Bald Man Speculating, named after, this noggin right here. And I have put up 3 new podcasts, between Christmas and now. So if you like those, go and check those out. And the Substack, we are running a best of 2024 for our Substack. So go check that out. That is at paulmampilli.substack.com. That is completely free. And all you have to sit through is like a little pitch saying, hey, if you like what you see, want to subscribe, check us out. So pretty much all of our content is very light on promotional activity. We're focused on the investment ideas. Social media, which again allows me to write about all kinds of things and allows me to be very current. Twitter or X, I'm pretty active all the time. Instagram, reasonably active, and Facebook, we are pretty active there as well. So you want to follow us there. Then finally, if you want paid subscriptions, which entitle you to what? Well, you get the trades in real time that we make to our various model portfolios. We have 3 sort of buy and hold style portfolios, which are silver, gold, and diamond. And then we have platinum tier, which is our short-term-ish. It is not a trading portfolio because we don't turn stuff over day after day. There's not a trade every day, but it's shorter term than the others. That's what you can subscribe to, and subscriptions begin at $9.99 per month. Okay. 2024, you can almost count it in sort of 2 halves. You got the first half where things were choppy to down, second half where things started to improve, and then obviously post the election, we had, big explosive moves. But that doesn't really tell the full story. The truth is that there is this enormous transition that is happening in the stock market that is being hidden by what the big indices like the S&P 500 and the NASDAQ 100 are doing. We are seeing mass underperformance of a lot of stocks, and the big indices are being carried by a tiny, tiny group of stocks. I mean, the level of concentration in the S&P 500, I believe, is at an all-time record. The top 7 stocks represent 32% of the index. The top 20 represent 50% of the index. So you got 50% of the market capitalization of the S&P 500 in 20 stocks. 50%. So the remaining 480 are the remaining 80, like, yeah, 400 and yeah, remaining 480 get 50%. So, I mean, it's, I mean, extremes can go to greater extremes. I mean, people are essentially just bidding up the same things to higher and higher and higher levels. Um, and that is the pattern that we have been in for the better part of, I'll say, 12, 24 months. So, I mean, Apple trades at 10 times sales, which is, an all-time high. We obviously also have stocks that are trading at crazy highs. The difference is that our stocks are relatively young and relatively early in both their life cycle as businesses, life cycles as technologies. Like, I mean, I've talked about, people ask me about Palantir. Palantir is like, trading at 70 times sales. The difference is that AI is, pretty early in its in its implementation. And so while, historically paying 70 times sales is just not a good idea, if you're like, hey, I want to be in AI, and what can I own? And people are like, well, you got to own NVIDIA. Full disclosure, we don't have NVIDIA in our portfolios. And they're like, well, and then what from there? And then you're like, semiconductor stocks. And then you look and you're like, yeah, but how many really have exposure to AI? And then you very quickly, it's like, there's not that much that you can really own that gives you exposure. So this is how you get like these big moves in stocks, and where everybody herds into one or two names because people want exposure to AI. I mean, people are desperate for exposure because everybody correctly assumes that this is a huge trend, is a big trend, is a long-lasting trend. But what to buy? What to buy? I mean, NVIDIA is a $1 trillion company. Palantir, on a relative basis, if you're just comparing these two, is cheaper. Is cheaper. So what does that mean? I mean, stock market is sometimes an absolute game. In other words, 70 times sales, high, sell everything, sell it, get it out of here. And then sometimes it's a relative game. Oh, well, comparing it to this is cheaper. I'm going to buy more of this. And I think that's kind of like what's, we're seeing. And that's one of the undercurrents of this market, which is that we are starting to see more relative bets being made because people want exposure to certain trends. AI is obviously a very big one. Crypto is a big one. We're going to have others unfold as 2025 sort of like happens. And we'll see again, like, because why? Well, I mean, after a very tough 2 or 3 years, a lot of innovation and growth companies have been, their stocks have been destroyed. And there's not that many survivors. And then, like, many companies, even any industry, they're not great businesses. I mean, they were brought to the market in an environment where interest rates were at 0%. Clearly, investment bankers seeing the enthusiasm of people to buy, speculative growth, innovation stocks in 2021, brought a lot of these to the market. But when you get down to it and you like, hey, well, I want an actual business. Like, you can argue about the valuation of Palantir, but they have an actual business. They have real customers. They are dominant in their business. And then you're like, what else would I invest in? And yeah, people will say, like, Paul, look at this, look at that. But yeah, they don't dominate that business. They're pretty speculative. Maybe they have a small business, but the history of markets will tell you that, the greatest gains tend to come from like the biggest players. They capture the greatest market share in terms of investors. And so you tend to get the greatest gains. I mean, look at all the tech stocks. I mean, are Apple, Amazon, Meta, Google, I mean, are they bit players in their businesses? No, they're dominant players in their businesses. I mean, they completely dominate their businesses for the most part. So that same effect, that is the undercurrent that's there. And then there's this relative valuation game rather than an absolute valuation game that seems to be going on. So I think 2025 is going to surprise people. There are going to be some new winners in new areas. I think some of that is pretty clear. Some of that is not so clear. And I think that the S&P 500, the big indices are going to stagnate. I don't see a crash. I know that there are people in my old business, the newsletter publishing business, that are calling for crashes and this and that. I tell you, I think these are just ways to try and sell subscriptions. There's nothing indicating a crash. And the number one indicator for a crash is really one thing, which is that people owning a lot of stock on margin and not having a lot of money. I mean, when there is liquidity in the marketplace, when people have crash, it's difficult to have a crash. I mean, a crash is essentially the lack of money in whatever the system. In other words, people own too much, and as they start to get liquidated, there's nobody that wants to buy, or there's nobody that's even capable of buying, because they spent all their money, they're margined out. Like, there's essentially we've run out of buyers. And everything we are seeing is that there is cash aplenty in the markets. There's plenty of cash. Whereas this is just a liquid market. In other words, all like 16 years of everything from quantitative easing to deficit spending to everything has left like the economy flooded with cash, has left markets flooded with cash. That means, I mean, I'm not saying stocks can go down 10 or 15% or 20%, but I think like you saw in 2022, like there were buyers that came in, at like what, 25, 28% down. Man, I was like, people like buy. I was quite different than 2008 or 2009. I mean, you had days in 2008 where all those indices were down, 6, 8, 10%. No buyers. I know. I mean, I was running a very large hedge fund and we were trying to liquidate hundreds of millions of dollars worth of stock. Now they were maybe a half hour liquidity. In other words, there's maybe one or two buyers. That's not the case right now. I mean, so I think maybe we'll get some marginal highs, but I doubt you'll see another plus 30% year. Because, I mean, if you've got 32% in 7 stocks, 50% in the first top 20, in other words, even if you have big winners among the remaining 480 stocks, they just don't represent enough of the S&P 500. They don't represent enough of the NASDAQ 100 to move that index higher. So if we start to see this movement, into, again, relative valuation games, hey, this is a multi-trillion-dollar company, and this company, which is growing, it's obviously not as big, but they're growing faster. And I think I'd rather pay, what historically seems like a very high multiple for this than own this. So then you get the big names stagnating, and then you have smaller names that are doing better, but they're not big enough to move the index. And then it would take, a lot. I mean, the level of concentration when 7 stocks represent 32% of the index. I mean, that's enormous. I mean, it's not clear. That's an extraordinary level of concentration. So I would say after, I think 8 years when bigger was generally better. In other words, you wanted to own the big stocks that dominated the big indices. I think we want to be in a stock picker's market. In other words, you'll need to be in something smaller that isn't one of these very big stocks. The exception there, in my judgment, is going to be Tesla, and that's because they're in a newer industry where, despite it being a $1 trillion company, the level of skepticism towards Tesla is wild. I mean, people still hate that stock, hate the company, hate Elon. And so, there's people that short it. That's all good for future demand because all those shorts are going to have to cover at higher prices. So Tesla's the exception to the sort of like the big stocks that are out there. Um, Primarily because, like I said, there are people who are on the other side that are going to have to cover at higher prices, and they've got the potential for upside surprises. No one really can say that, hey, we're priced in robo taxis. Why? Well, because we've never had that before. We really don't know what the end economics are going to be. We don't know what the size of that market actually is. We've never had that industry before. We've never had a robots, essentially, robots transporting human beings. I mean, there's some historical parallels, if you will. Like, I mean, when the airline business first started, we've never had people flying in the sky, right? I mean, and there were high flyers like Pan Am and TWA in their time, right? I mean, those stocks, had like 15-year bull runs. But nobody really knew at the beginning, like, how big is this industry? How profitable are? What's the business model? Those things are all to be worked out. And to the extent that people were skeptical and questioned it and etc., it meant that people stayed out of those stocks. So then they were all latent demand as the answers got worked out. So this is another aspect to it, which is that many of the winners are going to come from something that we've not seen before in its current form. In other words, we've always seen innovation, we've always seen change, and people, you'll know that the change is real because the biggest changes draw the greatest level of skepticism. That makes sense. I mean, the more like the change is like going to impact human life, the more people it's going to affect. And generally, you will get the greatest skepticism, the greatest amount of hate, the greatest amount of questioning from that. So if you use that as a standard, well, I mean, 2025 and beyond, I mean, yeah, it's going to be good for Tesla. It's going to be good for crypto. It's going to be good for Bitcoin. It's going to be good for so many different innovation driven investments. And when you go on social media, don't look for people to agree with you. Look for like the greatest level of disagreement. Like the people that are just gushing hate towards an investment, that one. That's the one you want to go and be like, okay, oh yeah, I mean, like MicroStrategy. Like, I mean, it's down 45% from the high. Everybody was perfectly bullish at 540. At 300, like, oh my God, Michael Saylor, he's an idiot. He's diluting a stock. Is this, that, and the other. So this way of looking at the world will point you to where to invest, because the greater the skepticism, and you have to assume the skepticism is wrong, obviously. Well, the bigger the winner. I mean, and look back over the last 10 years. I mean, what are some of the best performing investments? It's things that people generally told you to stay away from. Bitcoin, Tesla, right? I mean, so this is going to continue. I mean, Palantir, MicroStrategy, I mean, you can go on, right? I mean, so just when you get out there, just understand, like, seeing people agree with you in social media or even in real life is not some test of like whether or not you're going to make money in investment. To the extent that you have done your work. I don't think like being like a naive contrarian, like, oh, everybody, like, you take some select group of people and you're like, they all hate it, so I can buy it. Yeah, I don't work like that. I'm saying like you do actual research. You go and look and, you have some vision of the future and you're like, hey, if a company has spent 7-8 years and billions of dollars investing in autonomy, and they are telling you we are going to introduce robo taxis, and they are telling you like, hey, this is a multi-trillion-dollar business, and the world doesn't take them very seriously, and you have somebody who has a proven track record of making previously uninvestable, so-called terrible loser businesses into winners like Elon, yeah, it probably behooves you to like be like, yeah, maybe I'll bet with the winner, rather than, all the folks that are skeptical. The same thing with Bitcoin, the same thing with MicroStrategy, obviously the same thing with Palantir. In other words, you're going to need some conviction, you're going to need some vision, some view of the world, and then you do your work, and then you got to pony up some courage, some guts, and you got to make the bet. And that also means that, because there is uncertainty that, that like, hey, well, I can't assign 100% probability that this is going to happen. You'd be like, okay, so I'm going to need a portfolio. Too many people, I think, like come to troll me, ratio me, because like they made bets on 1-2 companies, and they lost money and they lost their shirt. I mean, hey, I take full responsibility. In a portfolio of whatever, of 200 or 300, there are going to be tons of losers, right? There's no way anybody that does what I do is going to have all winners. And I can tell you that in the future, as like we get to a slightly different environment where not everything goes up, right? I mean, just understand, like, there's so many people who are so inured to the idea that everything will go up. Why? Because we're looking backward, right? We're looking backward and saying, but Paul, look at that market from 2009 to 2024. All you had to do, was just like be there and buy it. Yeah, but what were the conditions in 2009? Yeah, I mean, the conditions in 2009 were what? Interest rates were crazy low. Prices were crazy low. Valuations were crazy low. People's expectations were what? That we were going to have a Great Depression, right? That we were going to, like essentially the United States and capitalism might end. Yeah, that's not the assumption set anymore, right? And obviously, people tend to what? They looked at the crash and they're like, it's a terrible time, Paul. I was bullish in 2009. I was bullish in 2009. And the hate that I got, woo, I mean, why? Well, because people had sold, right? I mean, we will, we it's not like we search out like evidence or facts. What we do is we want people to confirm our position. So once we sell, be like, find me a bearish guy, tell me that I'm right. If you sold and you find a bullish guy, you're like, you're an idiot, you're a fool. How can you not see that the market just crashed? But the other side is like, how can you not see that prices are low? How can you not see that valuations are low? How can you not see that the government is taking everything in their power to liquefy markets, to liquefy the economy? Yeah, but as I like to say, like, price is everything, everything. Nobody cares a crap about evidence. Nobody gives a crap about facts. Nobody gives a crap about research. Price is everything. Why? Well, because price is what, drives our emotion. And it's our emotion that, it's like, okay, buy. Okay, sell. It's our emotion. So at the current time, I mean, if I wrote like a super, like, even if I was like said like, hey, I think like the S&P 500 is going to like stagnate, man, I'm going to get like trolls be like, you're an idiot. You're a fool. Can't you see it's been up 20% for the last 2 years? Yeah, I can see. I mean, I can see. I can definitely see. But having been in markets for 30 plus years, there's a yin and a yang, and it goes opposite to however strong the emotional pull is of whatever you like feel like you want to do. In 2008, 2009, what was the emotional pull as prices just plummeted down? To sell. What is the emotional pull when you see prices just keep going higher and you are out? Well, it's to buy. And remember, like, yeah, and like those are like the ways that we actually process the world and see the world. We don't really consider the facts, the evidence, because that was all around in 2009. I mean, I was working for Horizon Kinetics. I mean, we were telling people, look, I mean, this is going to turn out to be one of like the greatest opportunities to buy. You think that message was received well? I had a guy, a tall dude, tall Dutchman, like stand up to try and like beat my business partner, my boss. When we said that, why? Well, because they had bought in at higher prices, and they were down and they had sold and they were angry. But it doesn't change the fact that, like, facts are ultimately what drive the long-term results. And so you got to keep your emotions out of it. And from that perspective, looking forward into 2025, yeah, these are the facts. Unprecedented levels of concentration in the S&P 500, NASDAQ 100, etc. Dominated by, yeah, pick your number, 7, 10, 15, 20, max, 25 stocks. Like, then we've got, yeah, all the leftovers, which represent nothing. And that's where the vast majority of our companies are. Like even Palantir, whatever, it's a $130 billion company. But remember, Apple is a $3 trillion company, right? You'd have to be like, yeah, to make like Palantir into a $1.3 trillion company, would have to go up 1,000% next year. It's not going to go up 1,000% next year, right? To get like, anything to become anywhere near the size of Amazon, Google, essentially like the big companies, yeah, you're going to have like multi-1,000% returns for all of them to happen in the next year. And that, might drive the S&P 500 and the NASDAQ 100 higher, but yeah, you're not going to get that. I mean, like when you go and do like, the best performing stocks of 2024, you're not going to find 200, 1,000% winners. You're going to find, a few, but then you'll have, like a few in the hundreds, then, then there's 50 and 30, and then there's a long list of losers. And that is the pattern every year, pretty much. All right. So we're going to see some surprising things unfold. And the macro environment is completely different than what it was for the last 16 years. Interest rates are not going to go back to zero, just not going to go back to zero. They're at 4%, and I theorize that they will stay in a range for, I'll say, like 7, 10, 12 years. And that's based on looking at, so like the last interest rate cycle where interest rates were going up. That was from like 1940 to 1980. That had a slightly different pattern. That's like what, post World War II. And their interest rates just kind of like trickle up a little bit at a time for 28 years. It goes from 0 to 5.3% from 1940 to 1968. Contrast that to today, where we went from 0 in 2020 to 5.3% in the space of like essentially like 18 months. So we packed in what had happened in the last cycle over 28 years into 2 years. The way I see the world, that suggests that we are going to be in this like band of interest rates for a long time, 10, maybe 15 years. In other words, when interest rates go lower, people will panic. We're going to go back to zero. No, that's backward looking. People have that expectations because of what that happened in the past. And so if you think that like, okay, interest rates are going to be in some range, let's say between 3 and 5% for 5, 10, 15 years, that's a good environment. It's not as good as zero interest rates. But it's a good environment if you're a growth company that has significantly better growth than that rate. That's going to draw more investors in to the extent you actually have that growth. It is also going to be punishing for companies that, yeah, I mean, at 4%, if I can get 4% in the bank, it just generally drives down the demand for speculative companies, for companies that need cash all the time. Why? Because there is a cost. There's an opportunity cost, as they call it. Before, the opportunity cost was what? Well, your bank was giving you zero. Your money market was giving you zero. Now you can get 3 or 4%. 4% compounded over time is a decent amount of money. So there's less of an incentive to speculate in a non-zero interest world. So this is a big change. And then looking at the conditions, I mean, In 2009, prices were low, valuations were low. They were low for, for the financials of that time, right? Forget looking forward, right? So today it's, valuations are high, and valuations are high. It means that people are pricing in, an increasingly bigger and bigger future of many companies that today, while people see them as sexy, growth stocks. Listen, Apple was founded in 1983. It's a 41-year-old company. Amazon was what, like I think 10 years later. Um, these companies I mean, there's like a certain like size at which they also will stagnate. There's no guarantee. It'll go higher. And even if they go higher at high valuations, somebody has got to come and be like, I'm willing to pay 15 times sales. I'm willing to pay 20 times sales. I'm willing to pay 30 times sales. That's how gains are generated. It's not necessarily from the growth of the business. The gains are generated as a result of us, paying more for whatever, a dollar of earnings, a dollar of sales. And that is driven not by research, not by evidence, not by facts. That is driven by this emotional thing, like just like, hey, this thing's going up. I want to participate. I don't really know. Paul talks about all this fancy crap about, price to sales and all this, but all I know is the price is going up and I want in. And that's what, drives that incremental demand until a big investor comes and be like, you know what? I've made whatever, 7 times my money, 10 times my money, 12 times my money. I'm going to start to sell. And then another big investor comes and be like, I see that person selling. I think I'm going to take something off the top. And now the demand is not there. And now, there's no longer any incremental buyer with enough money to keep pushing the price higher. And I think we're at that point for many of these very large stocks that represent, the vast majority of the S&P 500, NASDAQ 100, et cetera. So changes are coming. I think I believe that they're good for us because generally we're in smaller companies. We are in innovation companies, and our companies have growth. That's what we have. I mean, we are exclusively focused on what I call opportunity growth and innovation. Innovation is the best way to growth in the current environment. There are new technologies that you can use, utilize, implement to create new products and services. And if you can get that right, and you can take market share from incumbents, that's your growth. As like Jeff Bezos like to say, your margin is my opportunity. And there are a lot of legacy businesses that their prices have just, the stocks, their stocks just been bid up like crazy over the last 3 years. And that's just purely stock price. You go and look at their businesses. Yeah, they've grown by 2 or 3%, or maybe they had one good year after, stagnating for the previous 7, 8 years. And people are paying 30 times earnings. People are paying 10, 12 times sales for something that's growing at 3%. People used to justify it and say, well, Paul, but they have a dividend yield of 3%. Yeah, well, you can get 4% by leaving your money in money markets. So you can't. So many of the justifications for owning many of these things that have just rocketed higher last 3 years is now gone. So you're going to have to go through the world and be like, yeah, what do I want to be in? What is the sort of the underlying reasoning and rationale by which somebody will want to come and pay a higher price for this? And it can be obviously off the business itself. It's growing. And, obviously if you're capturing a business, like many of our growth stocks are still trading for 2-3 times sales, right? And they're growing at 25 or 30%. So there, it's quite easy for someone to be like, yeah, I can buy that, because they'll do what? A comparative analysis. I can buy this growing at 15, 20, 25%, or I can buy this, which is trading for 12 times sales, 30 times earnings, and growing at 2%. Yeah, I'm going to go here. So that's, I think, you're going to see a lot of that kind of thinking being used by big money investors, and big money investors, well, they drive, like the trends. They drive the trends. I mean, they've got the most money, and as they move from one thing to another, uh, yeah, they push prices higher. So our goal is to try and anticipate that. Like as I like to say, we're like ants, and we're looking for like elephants to jump onto. That's going to take us for a long distance, and to be on them as early as possible, because some of these folks are running obviously hundreds of billions, trillions of dollars. Yeah, we want to jump on their back and just take ridden higher. And for that, you have to be put yourselves in the mindset of what drives them. Well, what drives them is the calendar performance. They got to perform. They got to perform. I mean, that's a whole bunch of them. Then there are slightly longer term folks that are there, and they're in things where they have very high conviction. They have a lot of money in it. I mean, people like Ron Barone, that's been in Tesla for pretty much since the beginning. I think as at the private level, obviously Kathy Wood and others, where they're big positions. And then, of course, there's going to be smaller emerging ones. But either way, the game is going to get more interesting, more fun. And at least for me, because I love doing this, for me, it's the greatest puzzle on the planet. I mean, you wake up every morning and the puzzle changes a little bit. The pieces change, a little bit, or where the pieces go changes. The shape of the pieces change a little bit. So there's always something that's going on. And we've got macro shifts, interest rates, inflation, completely different than the last 16 years. We've got, the state of the big indices, which, previously, that's like a one-stop answer. Like, what should I do? Just buy the S&P 500. I don't think that's going to necessarily work out. People will disagree with me, but hey, this is my opinion. If you want to troll me, you can, but you're entitled to have your view. This is my view. And then there's also other things like Trump 2.0 is going to be quite different than Trump 1.0. I mean, tariffs for anybody that wants to export into the United States. What's the model for that? I mean, when have we seen that? I mean, I can really find a great precedent in modern times, but imagine, anyone that wants to import something into here, if they don't negotiate some kind of equal access for American products and services, they're gonna have to pay some 30% tariff. So yeah, I mean, there's a downside to that. So if you're very export driven, I mean, if you're someone that like China, I mean, they export so much to the United States. And if you're someone that chose to put almost all your production in places like China, yeah, it's going to be a tough time. I mean, and we've got lots of those companies in the S&P 500. Equally, if you are a newer company, a smaller company, you don't have any production in China. I mean, not all, some small companies do, but for the most part, you produce over here, you produce for the local market. And those stocks have not been bid up, right? I mean, those stocks are cheap. So that's a place where, again, we've got governmental policy, a big trend that has been in place. For globalization has been a trend for, I'll say, 30 years. I mean, depending on when you want to start the clock. Some people start the clock at the fall of the Berlin Wall. Some people, start the clock, say when Nixon went to China in 1970s. Whatever, however you want to start the clock, it's been around for a long time. A reversal of that is like a major change. I mean, you'd have to look at every company and be like, how will this company perform in a world of tariffs? How will this company perform in a deglobalized or an unglobalizing world? It's not like we can just turn off globalization completely. It will obviously be a pendulum shift that goes this way, but in what form? What are the specific things that's going to happen? Well, we'll start to get our first sense of that with implemented policies in 2025, and they are definitely going to be losers. There are definitely going to be losers, and there are definitely going to be winners. but is not going to be a replay of what we had for the last 16 years. So lots of change, lots of opportunity, lots of new things to consider. If you're someone that loves markets, you're someone that loves the game of investing, this is great. Right? I mean, we've got almost like a new puzzle that's being formed. So new pieces, new players, all trying to like solve it at the same time. I believe that, like having gone through 3 very tough years, right? I mean, our peak for like growth stocks, which in hindsight, yeah, I mean, clearly there was a hype and a bubble element to it because of low interest rates, because of like that initial enthusiasm of everybody, like joining in the markets for the first time after being locked down. But now, like that froth has just like been destroyed. I mean, we had a brutal crash and a bear market for opportunity growth and innovation. I mean, companies going bankrupt, 80% pretty much across the board, declines from the peak. Even high quality companies got smashed. In other words, people were like, I don't care. And as someone that went through this, holding that portfolio and dealing with people on social media coming at me, I can tell you that very few people are in. Like we are, us, Kathy Wood, Ron Barone. I mean, the stalwart growth investors are the only people that really stuck it out. In other words, why? Because we had some conviction, we had some belief that this is right and this would be temporary, and that there's going to be a rebound, and that the rebound is going to take you to even higher growth, right? And it's going to take you to even higher values. And that process is just beginning. And to the extent that, you put all this together, if interest rates are going to stay in a range, 3 to 5%, yeah, I mean, our companies will kill in that environment. But 3 to 5% is pretty tough if you're a business that is only growing at 3%. And you've got competitors that have based their business models, their products and services on a digital platform, which has obviously financial efficiencies that you can't tap into. They can implement AI, they can implement, new technologies much faster as a result of it. Yeah, your economic returns are going in the wrong direction. Yeah, ours are going like this. Ours are cheap. For us, the fundamentals are good. Interest rates, yeah, if you're a company, you're in charge of a company that's growing 15, 20%, 3 to 5% interest rates, not such a big deal. Just not such a big deal. Why? Well, because you're at the beginning. You're at the beginning. But you've been around for 50 years. And you mostly really you kind of need, conditions to be ripe, at least for your stock. You need things to be like, here's 0 and here's our 3% dividend, which we want you to value very highly. Yeah, 3% dividends. Yeah, why would I bother with that? I mean, there's no reason to be in a stock for 3% dividends anymore. And yeah, okay, I've gone on and on. I will say that if you're in our stocks, we will turn some stocks over. I'm sure that not every stock is like an enormous winner, but to the extent that my vision of the future is right, and there's every indication that it is, whether it be robo-taxis, whether it be crypto and Bitcoin, the implementation of fintech, digitization in general of more and more parts of our society. And then there's, we really haven't seen like a major part of our portfolio do anything, which is biotechnology and genetics. There is so much innovation there that can be unleashed by some amount of more reasonable regulation of this sector. Yeah, that is like the sleeper, if you will. Right now, almost no one is focused on it. Because why? Well, because we have no price effect. There's no big winner you would point me to. And remember, we are carried 100% in terms of our satisfaction with our investing by price. Price go high, I happy. Price go down, high, unhappy and angry. So analysis, research, evidence, fact, nothing, nothing. I mean, it means nothing. So biotech hasn't produced any big winners. Genetics hasn't produced any big winners for a long time. But what does it mean? It means that those things are cheap. So we're going to see some. This is a sector that sat dormant now for a long time. But that's where the biggest winners will come from, because they're cheap, they're low, expectations are low. Nobody owns them. As they come to own them, they got to bid it significantly higher. All right, we got a few comments, and let's go to those quickly before we end this live stream. Not giving us a heads up. Oh, I mean, listen, it's the holiday. The team is off. I could go and pose for a thumbnail. I think that people who are on YouTube and consume social media underestimate how much time, trouble, and effort it takes to actually produce the content. Obviously, there's what I talk about, which I prep for to some extent, but I'm doing the work every day, so that's not extra. But the thumbnails, etc., it's like I gotta think like, okay, like what should I put on there? Because if you're going to put a thumbnail, you got to put some trouble into it. Otherwise, it's not worth putting the thumbnail up. In other words, it doesn't do anything. So yeah, I mean, you got to deal with it. Hopefully, the content is sufficiently valuable that you care. And you come and you're a regular live stream viewer, and I do appreciate you attending. Let's see here. Where do you purchase Fannie Mae stock? The answer, there's no one answer for any person. I mean, like some people like to buy on the way up. Some people like to buy on the way down. I don't know who you are. I don't know what your risk parameters are. I don't know how much money you have, and I don't know how much you plan to buy. So I will say, in general, we guide our subscribers to follow something called rules of the game. In other words, you dollar cost average in and target some price that you feel comfortable with. There is no perfect price, because you know what? Remember, the stock market is a daily auction. I'm going to repeat that because most people don't think of it like that. It is a daily auction for a piece of merchandise. And yesterday's price is yesterday's price. When you show up for the new auction the next day, if there's suddenly the appearance of a large seller, the price will go down. If there's suddenly the appearance of a large buyer, the price will rocket up. You go to the next day, new daily auction with completely different buy and sell dynamics. So what I have found is that when I attempt to answer this question, this is a trap for me, because I will come back. Paul, you told me to buy here and I lost money. You're a jerk and an asshole and an idiot and a dumb person. So you know what? I have learned my lesson. Yeah, I mean, no, I mean, I don't tell people exactly what to buy. If you subscribe to ATG Digital, listen, you're on your own if you choose to buy. That sounds like a cop-out. Well, so be it. We put our money into model portfolios. From there, you're like, hey, do your own work. Come up with your own thing, which is like, you can ask me questions about it. But in the end, when I get asked this question, people think like, hey, if you tell me this price, that's the low. No, prices fluctuate so much from day to day. So if you want the perfect low, you better believe that 95% of the time you're going to be wrong. So best to target some average price. The critical thing is do you believe in the opportunity, right? I mean, and the opportunity for Fannie Mae and Freddie Mac is that President Trump comes into power and frees these companies. What would they be worth if they're valued as regular financial companies? A lot of uncertainty there. I've thrown out numbers like, $30 to $40. Is that going to be real? No guarantees, but I've been in these things for a long time. That's what my opinion is. If you believe that, then you'll be like, hey, what's the likelihood of Paul being right? Seems like a nice guy, but I can also read, if I go online, people say he's lost people money. Maybe, I give him like a 30% chance of being right. Let's say I assume that he's right about $30 to $40. And then you would size your bet relative to that. And you'd be like, okay, and then you might go look and be like, Fannie Mae has traded between $3 and $2. Maybe I target something in between. That's how you go and rationally spec out a bet. And then, then you decide, like, should I actually act on it? I know it's a long, complicated answer to a very simple question, but having been in this activity of being a content creator around investment ideas and finance, I have learned to provide context to my answers. I am going to be traveling starting tomorrow, New Year's Eve. I'm going to be traveling. I'm kind of excited. I've never actually traveled on New Year's Eve. And I'm just expecting to get like champagne glasses, like, from the time I check in everywhere all along the way. And also I'm going to be traveling from JFK to Dubai. And so, I'll be experiencing New Year's all from, at every place as I go through. So a unique experience for me, and I appreciate your good sentiments, sir. Miss Puppy Pup, another regular live stream listener, says, Happy New Year. Happy New Year to you. Happy New Year to you. Thank you for your good wishes, and Happy New Year to all of you and your friends and families. I have done very well with holding on to your picks for the silver tier, especially Tesla and some of the gold tier. I just want to make it clear, we do not own gold stocks. The gold tier, that is one of the tiers. Started out with 6,000 and it's now worth 26,000. I have 20 stocks. That's amazing, and congratulations and well done. I am always, I don't know. I love hearing that people are finding ways to use the information, because just like stock investors who are much more affected by losses, I'm the same way. I got a comment on X the other day saying, somebody had made I think a total of they'd made, the second time they'd made $2 million. And obviously getting compliments like that is great. But when you get criticism, I don't know, it's just like a loss. It hits you harder than a compliment. But I'm very grateful for you saying this and showing people hey, our ideas have value. Ideas can make money, but they're not guaranteed to make money. You do have to find a way to utilize them to maximize it for your particular investment style, risk profile, financial profile, etc. Raul, another regular live stream listener. Hope you had a Merry Christmas. I did, and I hope you did too. And wishing you a Happy New Year, and same to you. Thoughts on AVAX and SQ? AVAX, Avalanche. This is a blockchain network with a token that has a lead in real world assets, which is starting to get media press attention. There's people talking about how, soon into the future, all stocks will trade on some blockchain network. Avalanche has put, the state of California, their DMV has put all of the titles of all cars in California on the Avalanche blockchain network. If this takes off, and just imagine, other be hey, well, they put it on Avalanche, we're going to put it on Avalanche. Yeah, well then, what? Well, then, every state government would need to own some amount of Avalanche, because to use the network, you have to use the Avalanche token. The activity on the Avalanche token will start to increase. That obviously will drive, buying and selling, which then also increases how much people might own in their own portfolios for it. And people start to now think well, could this go global? Could this go to other assets? Could it go to trucks? Could it go to construction equipment? So this is the process by which, something that starts here, you can visualize why its price can go higher. Because all prices are on some level are people visualizing a different future than currently exists. And obviously that future turning out to be true, or at least people perceiving that future is coming true. So that's the future that, I have visualized for Avalanche, which is that they can take this running start that they've gotten from the California DMV and turn it into something where they become, let's say, the default for all cars, all trucks, all construction equipment. And that then translates into other physical equipment of various kinds. And now they are the default blockchain network for that. That activity in humankind across the world is worth, trillions of dollars. Imagine all that going on the blockchain, Avalanche blockchain. Its token rockets higher. That's my thought. There's nothing so far to update. Remember, I mean, all our time frames are dictated by the last tick, right? But the world moves a little slower than that, right? I mean, state governments don't make decisions based on each tick. They do it in in the space of months or maybe years. So we're impatient for prices to rise, but the world moves slower than the price swings. So nothing really new to report on that front. I would expect that as part of an overall crypto bull market, obviously all ships will rise and Avalanche will go up with it. But I'm also hoping for like real developments that show adoption and utility. And now you've got a different class of investor, a different group of investors that, they've got way more money than just pure price speculators. And I'm hoping for that for Avalanche in 2025 and beyond. SQ is now called Block. It used to be called Square. They are one of the leading fintechs. And my view of this is that they, along with PayPal, have created, the digital bank. SQ has Cash App. If you don't know what Cash App is, go to your phone, go to whatever the Apple Store, the Play Store on Android, and download the Cash App. The Cash App is like this little mini digital bank. You can save money there. You can buy Bitcoin there. You can buy stocks there. You can get your taxes done there. It's like this multifaceted app providing you like a platform to all kinds of financial activities. And longer term, I expect a company like Block to replace most banks, the banks where they have branches and things like that. The way to think about it is sort of like Amazon, right? I mean, Amazon replaces stores, and you can see retail stores continue to shut down over the next, 3, 5, 7, 10, 15 years. The banking system is going to change. It is going to go more digital. And SQ and PayPal are early. They're very early onto that opportunity. And because of that, they're going to end up being, in my opinion, the dominant ones. They also benefit from crypto because they were very early in offering Bitcoin access. And crazy enough, today, there's still there's not that many places where you can buy crypto and Bitcoin. It's Coinbase, obviously. It's Cash App, Robinhood. I think Interactive Brokers offers access to it, but that's the only old school brokerage that offers access to crypto. So yeah, like my kids use Cash App, and I send them money on Cash App. They also have Venmo. Different people, tend to like one or the other, but those are the two sort of like digital banking companies that, in my opinion, are going to dominate the future. And thank you, sir. Thank you for that compliment. Tati says, my first live. Yay. Well, welcome. When I'm in Asia, I'll have to see what time I can do it. I mean, India is 10 and a half hours ahead or behind. And I think the Philippines, where I'm going, it's 13 and a half hours. So there'll be more sudden live streams. So use that notification bar. Or if you can't make it, I'm going to try and obviously do it for US time, but it might be like a little bit later or a little bit earlier, just so I don't fall asleep in the middle of the live stream. But if you use the notification thing, it'll tell you that I'm on. And then obviously if you can't make it, everything's recorded and shows up under the live folder. My take on MSTR, I kind of talked about this in my first comments. People who are upset about MSTR's volatility, well, let's see. I mean, I looked at it this morning. It's what, at 310. I was going to put this up since I haven't put up anything. And I know some people love charts. Yeah, it's a move of about 45% from the high. Take this off. That's a move of about 45, 43 to a low of 301, assuming that that holds, about 45%. Yeah, there's a guy that writes in on my Substack and likes to just essentially troll me. And he wrote me, is like, what do you have to say now that MicroStrategy has plummeted? And I said, MicroStrategy's volatility is desired and expected. The volatility there is by design. Why is it by design? Because the volatility allows them to sell debt. Convertible debt is valued based on volatility. So if the stock was not volatile, they would not be able to sell convertible debt. So it's clear to me that the playbook is as follows. When the stock goes up like this in a straight line, they sell stock. And then, they sell bonds, excuse me. They sell bonds because convertible bonds, they're valued off the volatility, and they might mature those bonds and they can resell and buy more. With that, they clear away old debt, incur new debt, and then as the price falls down, they issue stock. They issue stock partly almost because, when you issue stock, you create volatility. So there is this cycle that they are on, and if you don't like it, well, that's what you have signed up for. You have not signed up for like a vertical line higher. You have signed up for a volatile stock that is going to be 2 to 3 times more volatile than Bitcoin. That is programmed into the stock. It's programmed because that is the way that MicroStrategy raises money to buy more Bitcoin, with the idea that whatever amount of money they raise, whether it be through the stock market, whether it be through the bond market, that money is less than what the terminal value is of the Bitcoin that they are buying. That is the trade that they are making. We are willing to short cash using the stock market and the convertible bond market to buy Bitcoin. That's what they're doing. And if you don't like the volatility, well, hey, maybe MicroStrategy is a long stock for you. But that's the basic premise of this trade, right? I mean, it's going to be 2 to 3 times more volatile than Bitcoin. At its highs, it's going to trade for some crazy multiple of the amount of Bitcoin that it owns. That's driven by emotion, enthusiasm, and also, like, as people are forced to, there's a lot of people who short the stock, etc. And that is all by design. They want people to short the stock. Why? Because it drives volatility. More volatility means they can sell more bonds. Remember, they're selling bonds for 0% interest to buy Bitcoin. So this is what you have to endure if you want them to be able to accumulate as much Bitcoin as possible. So that's my view on MicroStrategy. Nice to see you again as well. I have been doing live streams pretty much every week. So come back. And then there's all the other social media stuff that I mentioned where you can still keep track of me. Coinbase and Robinhood. I mean, they're both, Coinbase is the largest publicly traded crypto exchange. They will see higher trading volumes as Bitcoin peaks next year. And then as we have an altcoin season into 2025 and 2026, that will drive trading revenues higher. People will come and want to bid it higher. When Bitcoin prices are selling off, people sell it off. So nothing's changed. I mean, these will go back to making 52-week highs when the sentiment shifts and people's like, I got to own Coinbase. I got to own Robinhood. Zoom and Teladoc. Zoom, in my judgment, and Teladoc are like one of these companies that people are going to come to in maybe 2025 and 2026 and beyond and be like, whoa, these are AI plays. Oh, wow. So the same thing that happened with Palantir could happen here. I use Zoom on a regular basis to record the updates for ATG Digital. And I have to say, like, even a fairly simple thing that they introduced, which is that they will send me a AI-based summary of 1 hour worth of video, and the accuracy of it and the level to which it can capture what I'm saying, how I'm saying it, small little shifts in my tone is mind blowing. Mind blowing. Yeah. I mean, we use it because like the team then takes that summary and then like writes the what they call the lift note that goes out with the update. So this is an AI company that has not yet been sort of like discovered, if you will, by the market as an AI company. They're still seen as a COVID play, as a work from home play, but I believe they're an AI company driven by video. They are definitely making moves in that direction. And remember, the biggest price gains come from some mixture of growth and also of like the price to sales multiple, price to earnings multiple getting bid up. Zoom sales have not crashed. Their growth has crashed. There is a difference, right? They had huge growth, like 300% growth in 2020 and 2021. And from there, they've gone to like nothing growth, but they still have the vast majority of the customers that they got during that COVID lockdown period. It's just that, once you get like 300-400% growth, it's hard to do another 300 or 400%. And the market values growth. The market values growth. So their price to sales multiple went from whatever. I mean, I'm making this number up from like 15 or 17 down to like 1. People tend to bid up price to sales multiple when companies are saying like, hey, we're growing at 30%. And, and we continue to see growth. And people are like, oh, I want to pay 3 times sales. I want to pay 4 times sales. That's how you get these big winners. And both of them, Teladoc and Zoom, are in the same position. They got this huge horde of new customers. They had huge growth in 2020 and 2021, and then growth fell off a cliff. And so the price to sales multiple crashed. If they can show even 10 or 12% growth, yeah, I mean, people will be like, oh, yeah, I'll pay 3 times sales. I'll pay 4 times sales. And suddenly you'll just see these things turn around and become big winners again. So they're in the same spot. They both are companies that are in the middle of big, broad themes, AI, digitization, also a shift, if you will, from, how work is done, where it's done. Teladoc, I mean, and Zoom, they're both companies that like where you're looking to optimize what you do by using digital assets. And they are both dominant in their business. There's no other real platform like Zoom, and there's no other platform like Teladoc. Yeah, I mean, many people say things like that, but I mean, I've been in markets for 30 years, and I can tell you there's always some view like that of like, hey, there is this, but I don't never find that it is positive or worthwhile to think like this, because you just end up excluding yourself out of big opportunities, and then you end up thinking, I should have, I could have, I would have. So, I mean, conspiracy theory, things like, yeah, maybe it's true, maybe it's false. But the truth is there's always opportunity in every market. In my opinion, crypto and Bitcoin represent one of the biggest opportunities out there. And I think if you focus on things like this, it ends up making you not want to make the investment, which then obviously excludes you from the gains that are out there. What is my view on 3D systems and desktop metal? 2 very different scenarios. 3D Systems is a dominant 3D printing provider. They make 3D printers, and I believe they, along with Stratasys, Protolabs, and some of the others are going to do extraordinarily well under Trump's tariff world, because if you're going to tariff anything that is produced elsewhere, even if it's made by an American company, people are going to bring production back to the United States. And modern production is going to go through 3D printing. So then you're going to see huge amounts of 3D printers and 3D printer farms being built out. This will be one of these waves that happen, and 3D printing is right in the thick of that. Desktop Metal is in the middle of like a very complicated transaction with another company that we own in Diamond Tier called Nano Dimension. Nano Dimension agreed to buy them for $5.50 in cash. Then Nano Dimension had a management change driven by shareholder activism. And so the new management doesn't want to follow through on this purchase. And so Desktop Metal stock is crashing as people anticipate that Nano Dimension will walk away from its purchase of $5.50. Nano Dimension doesn't have enough money to continue, at least when they were bought as an independent company. But depending on what happens, and if the 3D printing stock starts to take off, maybe it can have an independent life, which is why we haven't sold it. We continue to own both. If you buy Desktop Metal, it's a very risky play, but it potentially could be like a huge winner if either one of these scenarios work out, which is that Nano Dimension follows through and buys it for $5.50 in cash, or the 3D printing market takes off, meaning the market for 3D printing stocks takes off, and people be like, well, we're happy to give Desktop Metal the cash to survive. And now, because it's priced a little bit now like it's going to go bankrupt, which it still could. So risky, but potentially like in turnaround mode could make a lot of money. Yeah, again, like this idea that like BlackRock, I mean, remember, BlackRock runs index funds, right? BlackRock doesn't own these stocks. You own them. I mean, people use the word BlackRock for social media engagement and to kind of like get attention. But I don't think most people understand that BlackRock is a company that manages money for other people. Some of them are large institutions. Some of them are regular people. Your 401k might have a fund that is managed by BlackRock. BlackRock itself cannot buy trillions of dollars stock. People give them money and they're buying it on somebody else's behalf. They're holding it on somebody else's behalf. That's true for stocks. That's true for Bitcoin. This BlackRock conspiracy theory, I think, is going to keep plenty of people away from perfectly good opportunities. And I believe that it comes up because this is like so often repeated on social media and nobody really questions it. So I will tell you that I don't believe that stock prices are higher because of BlackRock. Stock prices are higher because people are sending money to BlackRock from their 401ks because of like actually a piece of legislation that was passed 15 years ago. Like before this piece of legislation was passed, I can't remember the name of the piece of legislation, but I think it was passed in 2006 or 2007, which said that an employer could, by default, simply say like, hey, when money goes into a 401k plan or a pension plan, it automatically goes into some kind of like balanced portfolio that includes stocks. Before, it just went into cash. And if you wanted to not be cash, then you would have to actually go and like say like, hey, I want it invested into this. Instead, there became like a default where they invested into stocks and bonds, et cetera, whatever. There would be some default portfolio. That just sends money to BlackRock, Fidelity, State Street. There's an entire set of folks that run index funds. And so money just keeps coursing in. That money doesn't really care what the valuations are, doesn't really care about analysis. It just comes in, whatever, it's 5% that's being taken out of your paycheck, and it automatically buys whatever, like what do they call, like lifetime funds, by year, and that has whatever, some amount of equities, some amount of bonds, some amount of cash. So yeah, this view, I I know it's widely put out there, but as I said to the last person that said, I think it's going to keep you out of opportunities to have this perspective. Any speculation how Shopify will fare in an era of tariffs? This is a great question. I think it will do very well because, again, it's the same thing, right? I mean, you're going to have more small sellers as people start up shops in the United States to sell to our local market. And unless you want to now be like, well, unless you're of such a size where like, I need to have Walmart or Target, I need to, get my product or service there, just like ATG Digital, I mean, like we're just there on the internet, right? I mean, so where would you go to start up something? Well, there's two places. Block has a small business sort of like platform that you can build your business on, and Shopify is the other one. So I think they'll do extraordinarily well in that scenario. Even though Shopify is originally a company that's, I think, like based out of Canada, that doesn't matter. Remember, I mean, like they operate in the United States and they facilitate small businesses. They facilitate internet businesses. So I think they'll do well. What about HBAR, which is a crypto token? Yeah, we don't own that. People have come and asked me about it. I think there must be somebody out there in the old newsletter world that must be promoting this, because I noticed that questions tend to sort of like come in as a result of that. I have no opinion on this. People write incredible things about it. I have not yet seen a specific use case for it. But there's no, I don't have like some like exclusive on great ideas. It's possible that it's a great idea. I just don't see it at the current time. I meant, what brokerage do you buy Fannie Mae on? I don't think you can buy it on Robinhood. I think you have to be with one of these old school providers like Fidelity, Schwab, E-Trade, which is now Morgan Stanley. I think you have to be with one of them to be able to do it. And even they may restrict it from time to time. You may need to go get special permission. Happy New Year. Thank you. Thank you. And same to you and your friends and family. You know what? That might be cool, but I think we might be too high up to see it. Too high up to see it. Thank you, sir. We have actually helped a lot of people make money, and it's equally true depending on what you have chosen to do with their ideas. We've probably also like lost people a lot of money. But as I wrote back to the person, I was like, listen, nobody has a perfect record. Even the greatest investors, whether it be Warren Buffett, Bill Ackman, Carl Icahn, they all have losers. They all go through bear markets. They all go through bad periods. So if you don't like that, well, those are the odds with anybody. All right, those are the odds. But I can say, and I'm proud to say, that we have turned people into millionaires. Not just one. I'll say, if I was to throw a number, I'd say 20, 30 people. Did they use some mix of what we were providing along with some understanding, sophistication of their own? Absolutely. I don't take credit for it. It's all to your credit. We're here to provide you ideas. And I speak as honestly as I can about them. You decide what you want to do with it. But thank you. We need stock letters for 2025, as you said, at Ben Hill Fang. I mean, we did Pumped last year, and I did Stars. Pumped did very, very well. Pumped was what? Palantir, Uber, MicroStrategy, PayPal, Exact Sciences, and 3D Systems. Let me get that up. Wow, this live stream is going long, so okay. I'll do that very quickly. Oh, yeah. Pumped. Yeah. So Pumped, which we started on October 10th, 2023, Palantir, Uber, MicroStrategy, PayPal, Exact Sciences, these systems. Yeah, you can see there's big winners like Palantir and MicroStrategy, modest winners, and then there are losers. And people say like, but Paul, what about Exact? Well, the entire point, if you look at the note that goes along with this, which I'll read. The point of making pumped is to create a portfolio with many different bets on many different investment themes at a moment when markets, investors, and sentiment was very low and prices were very low. Low prices go with low sentiment, bad news, bad feelings, and this is the time to buy. By making the pumped portfolio, I want to show that there are moments to buy for folks who have a longer term time frame of like a minimum of 3 to 5 years. Then I go on to say, no one knows which stock will show a gain first. No one knows which stock will have the biggest gain. No one knows which stock will be the last to go up or is just a complete loser. Not every stock in a portfolio will do well. Some are winners, some are losers. This is why you need a portfolio. And you will see that it is not a bug. It is a feature that you will see over time. The winning stocks dominate the portfolio return, and over time, the biggest winner will become the vast majority of your portfolio. That is what happens in every portfolio. The winners concentrate. Focus on portfolio returns, not single stock by stock. And you will see here that you can already see Palantir and MicroStrategy are completely dominating this portfolio. This is what happens in every portfolio. Every portfolio I've managed has the same structure. Like a few, whether it be 50 or 500, the S&P 500 has the same structure. Like now you've got like 7 to 10 stocks that, dominating the portfolio. But that wasn't true 10 years ago. I mean, they burbled up and now they dominated. This is why you need a portfolio. And the more stocks you have, the more shots on goal you have to make money. But that is not the approach most people take. Most people want to pick one stock, go all in, maybe two, go all in, and they want a jackpot. They want a lottery ticket. You can go for it. I mean, obviously, if it works out, it's great. But if it doesn't, you're going to lose money. So yeah, we had pumped. We had one that didn't do well. I mean, I don't want to be accused of like only talking about. So this is a portfolio that didn't do well. But even here, I want to show you. So we had a bankrupt stock here, right? This was called Steps. And the basic idea was I was trying to time the bottom of the new energy market, which I got wrong. But here, look, I mean, we had a stock go bankrupt. We have Tesla, one winner. And then we have Enphase, another loser. Piedmont Lithium, which is a minor winner, and STEM, which is another big loser. But you can see, like, if you had put all your money into SunPower, you'd have lost all your money. It was the cheapest stock. Many people would have been tempted to do it. But by diversifying, by having 5 in Steps, your performance, because you own some Tesla, was at least 3.5%. It didn't beat the market. It didn't beat anything, but it was way better than betting on one single stock. So this is another one of these portfolios that I put up. And while we're doing this, I'll end this there. I also, in a YouTube video, talked about sort of like going long and short various popular like ideas. Like, I mean, and I said, like, like imagine you sold NVIDIA and you bought Tesla. So in other words, like sort of being short one thing. And that was around the idea that AI hype had gotten like very high. And truthfully, at one point in time, Tesla was down like -20, but they're both done well. But like, yeah, if you short one and went long the other, you'd be up 20%. Then I suggested whatever that, like semiconductors, which are being hyped along with artificial intelligence, you sell those and you buy biotech, which is cheap and low in my judgment. This has not worked out yet. And then my last one was, the digital Berkshire Hathaway versus the actual Berkshire Hathaway. So you'd sell Berkshire Hathaway, it's up 15%, and be long MicroStrategy. That's obviously been worthwhile. Why bring any of this up? I mean, well, there's many different ways to play the market, but nobody should be betting their stack on like one stock. I mean, the chances of being wrong are very, very good. All right. I'm going to end this here. Went through a lot of different things in a lot of different ways. I want to wish all of you a happy new year, incredible celebration, and a 2025 that is filled with joy, happiness, health, and of course, incredible returns, including, hey, Bitcoin making it to $1 million. Tesla going to 1,000. We could throw more out there. But hey, Happy New Year to all of you, to your friends and family. Thank you all for supporting this live stream, for being part of the ATG Digital community. I'll see you next year. This is Paul saying bye.